Okay, and a couple of quick little housekeeping things here. Oops. Okay, good. And let me get that out of the way. And I'm going to go ahead and put up the textbook. Please make sure that you have ordered your Becker materials if you didn't already. Version 4.2 is all I have available for you, even though we're using 4.3, and then where there are minor differences between 4.2 and 4.3, I'll point those out as we go along. Couple of things you may want to go ahead and I always have the issue for some reason. I can never figure out what it is I do that causes e-learning to close on me after I've started the class. But let me go ahead and get it back. Okay, and I'll put it in student view because it's just a little easier for you to see what's going on there. And under chapter 1, there are 2 documents that we are going to use tonight. One is this one dealing with other comprehensive income. The other is the cumulative effect. And I have posted chapter 4.3 for folks that maybe haven't received their books yet. And I will probably do that for chapter 2, maybe chapter 3 as well. And then when we get to chapter 4, you really should have received the books by then. At some point, I'll stop posting those PDFs. So don't expect I'll have those every single time, okay? Also in the Becker software, you do have an ebook there that contains the same information that's in these chapters, okay? All right, now what I want to do, as you saw on the screen there, I'm going to put my machine and tablet mode and pray that the camera doesn't go out on me. Okay, good, looks like it stayed. I want to go to module 6. And the reason I decided to do this, because I think towards the end of last class, I said I would come back. I think it was to module 3. We covered module 5, and then I said, well, I'll come back to get module 3. But I think from a flow standpoint, it makes more sense to continue with module 6 to the end of the chapter, and then depending on our timing tonight, I'll come back and pick up module 3 and module 4, which deal with revenue recognition. I think that's a better way to go. Becker chooses to organize the material a certain way. It doesn't mean we have to follow exactly the way they've organized it. Okay, so I'm going to go ahead and jump us into module 6. Okay, and let's start out talking about accounting changes. Okay, and when we look at accounting changes, and then we'll come back and talk about really error corrections in a whole nother module. Okay, but when we start talking about accounting changes, and that's really the focus of this module 6, what we're saying is there are 3 categories of changes. One is change in accounting estimate. The other are change in accounting principle and change in accounting entity. And then if we make an error, how do we correct that error, not only from the standpoint of how is it presented, which is what's covered in this module, but actual adjusting entries to cover those, okay? So you start to take a look, and the first one we talk about is the change in accounting estimate. And they tell us that we should have prospective application. That means that there is no restatement for a change in accounting estimate. Okay. Now, the reason we don't go back and restate prior period financial statements for a change in accounting estimate is that financial statements, it's understood, are full of estimates. And if every time an estimate changed, you had to go back and change your accounting financial statements, restate them, you would be spending your entire life restating statements, and there would start to be a certain erosion in the confidence of the financial reporting in the markets. So FASB tells us that if there is a change in accounting estimate, handle that prospectively. That means that you use the new estimate in the period of the change in the estimate, and then you continue to use that new estimate going forward, and there is no restatement. So you look at this example, change in the life of the life of an asset. Okay. And so what happens? You take a look at this example. This is a very good example. We purchased a truck for $90,000, and the truck has no salvage value. And so we think when we first acquire the truck that it's going to have a 10-year life. So we take the 90,000, we divide it by 10 years. Okay. And we're taking depreciation expense, therefore, of about what? 9,000 per year. Okay. And we do that for year 1 and year 2. Okay. We take 9,000 year 1, 9,000 year 2. You can see it written out here. Now, what happens? During year 3, they realize that the truck is only going to have a total life of 5 years. Okay. Well, what happens if the truck is going to have 5-year life, and we've already taken what? 2 years? That means that the truck has what? 3 years left. Okay. So what happens? Notice we took the 90,000. We took what? We took $18,000 of depreciation, 9,000 in year 1, 9,000 in year 2. And so in year 3, it had what? $72,000 left. And if it only had 3 years left, you would take that 72,000 divided by the 3 years, and you would simply take depreciation of 24,000 the remaining 3 years. We don't go back and say, oh, wait a minute, year 1, year 2, no restatement. You just go forward with that new estimate. Now, a couple of important things here. Notice they tell us during year 3, and they don't tell us if it's the beginning of year 3, the end of year 3, or what. And it's because it doesn't matter. We will use that new estimate to calculate the depreciation for that entire year. I don't care if that change in estimate came January 1st or December 31st, it's of no consequence because we have better information before we have to go and issue our financial statements, and we use that better information to calculate our depreciation in year 3, and so on as we go from year to year. Okay. Now, one other thing, change in accounting principle that is inseparable from a change in estimate should be handled as a change in accounting estimate. And you say, well, what does that mean? Well, let's say I'm using, and they really should get rid of this EG in here because installment method really isn't allowed anymore. So that EG is not a very good EG. So just strike that out because there's no such thing as the installment method anymore. I get tired of sending these things into Becker. I send them in, and then, you know, Becker says, well, what page is it on? And I got to go back and forth through 50 emails to finally get them to change something that's wrong with their textbook. Okay, so anyway, change in accounting principle that's inseparable from change in estimate. Oops, that part's okay. Should be handled as a change in estimate. Okay, they don't even give you a complete sentence there. Anyway, change in accounting principle or incomplete thought. Change in accounting principle that are inseparable from a change in estimate are handled as a change in estimate. Okay, let me give you an example. Let's say I'm sitting here and I'm using an accelerated depreciation method. Let's say I'm using double declining balance. What double declining balance says to you is that the asset depreciates quickly in its early years and then more slowly in its later years, right? Now, what happens? Let's say that I change to straight line depreciation, say towards the end of the asset's life. Well, someone could say, well, John, are you saying that you think the asset depreciates evenly throughout its life? Or do we have what? Do we have somehow a change in principle because you went from double declining balance to straight line? Well, the standards tell us, well, if you have something like that where you're like changing estimate, changing principle, depends on how you look at it, treat it as what? Treat it as a change in estimate. Okay? Question on that, they didn't really give us a very good example. They didn't really write that very well. Okay? Okay, good. Now, you come over and you take a look at how we handle a change in estimate. And we've already said this, it is handled what? Prospectively, okay? Meaning that what? We do not restate for a change in estimate. No restatement. Okay? And if you need to flashcard that, you can. That's pretty easy to remember, but you can flashcard that if you need to, okay? Now, what happens? If the change in estimate affects future periods, okay, the effect on income from continuing operations, net income, and the related per share information should be disclosed in the financial statements. So in that example of that truck that we had, well, we're still owning that truck, and that change in estimate is still affecting the financial statements, right? Because now we're depreciating that 24,000 a year instead of 9,000 a year. We should report that difference in income from continuing operations, net income, and any related per share information. Okay. Okay, good. No restatement. Now, when you deal with a change in accounting principle, we have something called retrospective application. Okay. I want you to put down here the retrospective application, say that means that prior period statements will be restated. That means that prior period statements presented, squeeze the word presented in there, it's a little better, that prior period statements presented will be restated. Now, this is where it gets confusing, guys. So you want to pay close attention to what I'm going to say here, because it's a subtle point, but important point. You'll see some questions in your homework in which they'll say, you have a change in accounting principle. How should it be handled? Prospectively. What do you think? No, not prospectively, because change in accounting principle is what? Has retrospective application. So yes, it would be a retrospective application. So is it a restatement? And the answer is no, it's not a restatement. They don't call it a restatement. Restatement is a dirty word as far as the accounting standards are concerned. When they say restatement, that means you made a mistake and you have to restate it. So they don't want to use the word restate. So they call it retrospective application. But the reality is you restate the statements to show what they would have looked like had you been using the new principle in previous periods. Make sense? Okay. So you don't call it restatement, but that's really what it is. You restate the prior period statements, but you call it retrospective application. Okay. So flashcard that if you have a change in accounting principle, we call that retrospective application. And we have a change in accounting principle. That means that we change from one generally accepted accounting principle to another. Okay, so we had one principle, say we're using completed contract method, which we may or may not get to tonight. If we don't get to tonight, we'll get to it next time. You're using completed contract method and you switch to percentage of completion. Okay, well, that is going to be considered a change in accounting principle. and it will require the restatement. Okay. Now, the idea is, but we call it retrospective application. The idea is that you're using the new standard, not because it gives you bigger net income or bigger revenue or something. You're using the new standard because it presents your financial position, your results of operations better than the old method. That's the reasoning. Now, you may say, well, hardy har, I bet you companies don't necessarily adhere to that rule, that strictly, and you may be right, but the rule is what? You're doing this because you're trying to present better information. That's why you're changing, okay? Now, you come over and we have to calculate something called a cumulative effect adjustment. Here's what we do. We go back to all prior periods affected by the change. Could be 2 or 3 years, could be going all the way back to the beginning of the company. Okay, so we go back to all the prior periods affected by the change, and we pretend like we had used the new method in those previous years. And we accumulate the effect of our net income from using that new method, and we come up with a number called cumulative effect of change in accounting principle. And that cumulative effect of change in accounting principle is going to be an adjustment to the beginning balance of retained earnings of the earliest period presented. Okay, now, if we're dealing with non-comparative statements, then we only have what? 1 year worth of information. So obviously, the adjustment to the beginning balance of the only period presented is going to be what we'll do with that cumulative effect. Okay, so financial statements are being presented, non-comparative, then the cumulative effect of change in accounting principle is equal to the difference between the amount of beginning retained earnings in the period of change and what the retained earnings would have been if the accounting change had been retroactively applied to all prior periods affected. So we just go all the way back, calculate that cumulative effect, and we adjust the beginning balance of retained earnings net of tax for that difference between what retained earnings was versus what it would have been if we had applied the prior period in all other periods affected by the change. Now, if we're sitting here in what? If comparative financial statements are being presented. Now, comparative statements mean that we're doing what? We're showing 2023 and 2022 right next to each other, let's say. Okay, these are comparative statements. Then the cumulative effect is equal to the difference between beginning retained earnings, and they say in the first period presented. And I guess that's okay, but you could probably put in parentheses somewhere in here the word earliest. That says earliest, squeeze that in. The earliest period presented, because later on they start calling it the earliest period instead of the first period. And I'd like them to be consistent in what they call it. So the earliest period presented, if comparative statements are being prepared, then we'll make the cumulative effect adjustment, which is equal to the difference between retained earnings at the beginning of the earliest period presented and what retained earnings would have been if the new principle had been applied to all prior periods. Okay, so we're going to make that adjustment to the earliest period presented, and cumulative effect both for comparative and non-comparative guys is reported what? Net of tax, flashcard that. The cumulative effect adjustment is always presented net of tax, and I want you to flashcard that. Okay, now let's go ahead and let's look at the example that I have up on e-learning that I showed you earlier, okay, which is in this, I never know how to get all of my, I have to click on this little thing. How do I know? Any thoughts on how to get all of my programs that are open to show to me? It's always hiding me one. It's always hiding some from me. You guys know how to do that down here?
Multiple screens.
Okay,
How many screens do you have?
never mind.
Maybe click
Okay.
that little,
So, I know I had, I had it open, the Excel sheet, now it's closed. Maybe that's the problem. I had it open. I don't.
that little arrow to the right of the Adobe symbol might, yeah.
Yeah, no, I didn't see it there. So maybe it's not open. I don't know. I open these and they close themselves. There's some evil spirit that sits in my computer and closes things that I want to open, but that's okay. Okay, I can open it again here. But it is up on e-learning, okay? And this is the one that I'm looking for. Okay, it's there now, so I guess it's just that the software was closed. Okay, good. All right, so let's just go ahead and let's look at this example. I know this is a little hard to read, so you may need to widen your screen so you can see it. But let's go through this. And I have this example of company X begins business in 2018 using the completed contract method. So completed contract method, as we'll study a little bit later, possibly tonight, maybe next time, you don't take any profit on a contract until you are completely done with that contract, okay? Under percentage of completion, you will be able to take revenue as you go along, okay? Now, as you work towards completion. Now, in 2020, the company changes to the percentage of completion method. No income was recognized in 2018 nor 2019 since no contracts were completed. Net income would have been $100,000 in 2018, and in 2019 it would have been $200,000 had the percentage of completion method been used in those years. Net income is $400,000 in 2020 using the percentage of completion method, and would have been $50,000 had the company continued to use completed contract method in 2020. Prepare the 2020 statement of retained earnings section of the statement of stockholders' equity. And I'm telling you, for this example, ignore income taxes. You would do everything, of course, net of tax. Now, if you were given a tax rate and whatnot, but I just ignored income taxes. Now, if I'm using non-comparative statements, I have to restate the beginning balance of retained earnings for the cumulative effect. It's the only period presented, so it is thus the earliest period presented. And so since I hadn't taken any income in 2018, 2019, my retained earnings beginning balance would have been what? 0. I look to the periods affected by the change. And since they just started business in 2018, I would have had what? 100,000 of income in 2018. I would have had 200,000 of income in 2019. So I add those together, ignoring income taxes. My what? My cumulative effect adjustment to the for the change in accounting principle to the beginning balance of retained earnings of the only period presented, since it's non-comparative statements, is 300,000. I now have that restated balance. I go ahead and I do what? I take my net income for now 2020 using percentage of completion. I'm going to use that to prepare my 2020 statements. And so I have an ending balance now after adding my net income of 700,000 in the retained earnings. Now that's if non-comparative statements are being used, are being presented. If comparative statements are being presented, now I'm showing 2020 and 2019 side by side. So the earliest period presented is what? 2019. So now I start with 0 as my beginning balance for my retained earnings because I hadn't taken any income in 2018. And the cumulative effect adjustment is what? $100,000. That's what my net income would have been in 2018 had I used percentage of completion in 2018. I then go ahead and I prepare my income statement, my balance sheet, right? Statement cash flows, everything using what? using the percentage of completion method for 2019. So my net income for 2019 is what? 200,000, because now I've used that to prepare my 2019 statement. So I bring my net income into and add to my retained earnings straight from the income statement, right? And so the ending balance in my retained earnings at the end of 2019 is 300,000. That, of course, rolls over to the beginning balance for 2020. And then there is no cumulative effect adjustment because I'll just use completed contract to prepare my 2020 statements in this example. And so my net income comes in at 400,000. My ending balance in the retained earnings is 700,000, which, by the way, that is what it's supposed to be at the end of 2020, 700,000. That wouldn't change under the two if it's comparative versus non-comparative. Okay, now, question. Now, I gave you a series of questions down here to emphasize what might be some points you might see in a multiple choice question. The first one here, what should be reported as a cumulative effect change in accounting principle in 2020 if non-comparative statements are being presented? Answer was what? 300,000. It's 2018 and 2019's cumulative effect amounts added together, right? The 100,000 and 200,000. What should be reported as a cumulative effect change in 2020 if comparative statements are being used? The answer is what? There is no cumulative effect reported in 2020 statements because I would have dealt with that in the 2019 column of my comparative statements. What should be reported as a cumulative effect change in 2019 if comparative statements are being presented? That's what? That was that 100,000. And notice, guys, the last question here, this note down here is probably the most important thing here because that's something the examiners love to do. They love to tell you for 2020, the year of change, what the difference between the net income would have been under the two methods, the old one and the new one. That is not part of the cumulative effect. The cumulative effect adjustment is calculated in all years what? Prior to the year of change. So you would have done what? You would have ignored that 50,000 here. Question.
So I have a quick question regarding the cumulative effect change in accounting principle. How did that 100,000 come from? I'm not very clear.
The 100,000 is what my net income, this 100,000 right here.
Mm-hmm.
That's just a number I made up. The 100,000, I'm saying I used completed contract method in 2018. So my net income would have been 0. But under percentage of completion method, I'm allowed to take some income as I am working on that contract. If I'm 40% done, I can take 40% of my profit. So my net income, I'm saying, would have been 100,000. That number I just made up. So since it would have been 100,000 in 2018, had I used percentage of completion, I have to adjust the beginning retained earnings to the earliest period presented, which in this example, the comparative statements was 2019. That's saying I'm adjusting it for what would have been 2018's net income had I used percentage of completion in 2018.
Okay. All right.
It's one of the few times accountants get to pretend. Pretend I used, okay, 20 percentage of completion in 2018. What would have been my net income? Okay, 100,000. And I report that as a cumulative effect adjustment to the earliest period presented in this example, 2019. If I had had 3 years of comparative statements, there would be no cumulative effect adjustment because I would simply restate 2018 to show that I used percentage of completion there and they'd started business in 2018. So there would be no prior periods. There would be no periods prior to the change in which I wasn't showing them. Okay, so cumulative effect is calculated on periods prior that aren't being presented. And then you make that adjustment to the earliest period presented. Hello?
Yep, that clears my doubt. Thank you so much.
Yep. Question? Okay, good. Let's go ahead then. with all that, and let's go back to the text. And let's just take a look at, I don't like this example. You don't need this example. I gave you one. Okay, just get the ideas down that way. And then let's just go ahead and take back a look at some of the textbook. And let's see what they tell us about the general rule. Okay, the general rule is that the change in accounting principles should be recognized by adjusting beginning retained earnings in the earliest period presented for the cumulative effect change. And if what? Prior period comparative statements are presented, they should be restated, which is called retrospective application. So that gives us really everything we need right there. Flashcard that. And then let's look at the exceptions. Okay. And the exception to that general rule is under this idea of impractical to estimate. Okay. And it is considered impractical to accurately calculate the cumulative effect adjustment when the change, and if that's the case, the change is handled prospectively, like a change in estimate. Just use the new principle in the period of change and don't go back and restate anything. Don't use the retrospective approach. And an example of this is a change in an inventory flow assumption to LIFO to any other method. Okay, so from say FIFO to LIFO, weighted average to LIFO, whatever, then you don't have to calculate the cumulative effect adjustment and flashcard the specific example because the standards mention that specifically. And so I want you to have that as a flashcard. But it's the idea, it's impractical to estimate. Think about it. If I'm using FIFO inventory, first in, first out, I'm telling you what, the stuff that is still in my inventory is stuff that I purchased fairly recently, right? First in, first out. The stuff that stays in the inventory is the stuff that I purchased more recently. If I switch to LIFO, now I'm telling you that what? The stuff that I have in my inventory is stuff I purchased a long time ago. Well, think about it. What if you were a company like Macy's that's been around since the 1800s? What am I supposed to do? Sit there and figure out, okay, well, I was Macy's and, I still would have had a covered wagon, whatever, in my inventory. I doubt that Macy's sold covered wagons, but, that's going to be what? That's going to be too difficult to sit there and try to calculate, well, what would have still been in my inventory? So they tell you if that's the case, impractical to estimate, just do what? Just go forward with the new principle and then go ahead and, disclose the heck out of the fact that you have a change in principle and you're treating it as, prospectively. Okay. Okay, good. Now, change in depreciation method, and I've kind of already alluded to this. A change in the method of depreciation is considered both a change in principle and a change in estimate. These changes should be accounted for prospectively. Okay, so again, if you change from double declining balance to straight line, change in principle, change in estimate, treat it as a change in estimate. You just flashcard that. Okay. Okay, good. Now you come over and just one more. I'm not going to read it again. I think you understand now. Well, let's read it again. This is really more of a summary than anything. I don't know. They're calling it application of the general rule. It's a summary of what we've talked about. So the amount of cumulative effect to be reported on the retained earnings statement is the difference between retained earnings at the beginning of the earliest period presented and what retained earnings would have been had the new principle been retrospectively applied to all prior periods. Okay. The new accounting principle is used to present the prior, the new accounting principle is used for all periods presented. If you're presenting 2019, use the new principle in 2019. And if accounting change is not considered material in the year of change, but reasonably, you don't need that last. That's just forget that last one. That's too much now. Okay, but the new accounting principle is used for all prior periods presented and for the new period, the period of change. Question. Okay, good, guys. Now, look, I am telling you, you're going to get some questions on changing accounting principles, so make sure you make those flashcards and you're comfortable with that stuff, okay? Now, change in accounting entity, what happens here, okay? And if you have a change in accounting entity, for example, if a company presents a consolidated set of statements where there was an individual company before, that's called a change in accounting entity. That means we'll have retrospective application, which essentially means we're going to have to restate any prior periods that are presented, and we'll make a cumulative effect adjustment to the beginning balance of the earliest period presented. That's what retrospective application means. Now, let me give you a story here. So long time ago, long time ago, I get a call, you know, it's like 8:30 at night, 9 o'clock at night, I get a call, answer the call. Hello, John, this is your former student. No, how are you doing? Well, I finished the exam. I got my CPA, and I've got a question. I'm thinking you would be someone that would be able to help me out with this. I said, okay, what's going on? He says, well, I have a client, and last year, the client didn't present consolidated statements, but this year they want to present consolidated statements. So I finished the consolidation for this year, but we're showing comparative statements. So what am I supposed to do with last year's statements? And I'm like, well, you have to restate those to show what they would look like if they were consolidated last year. All I heard was silence on the other end, because the person is thinking, oh my God, here it is, 8:30, 9 o'clock. They probably have a deadline for the next morning. They probably spent the better part of the day, right, figuring out that consolidation for the new year. And now they have to go back and for the current year or whatever. And now they have to go back and do a consolidation for the prior years so that you have something comparing apples to apples, right? Okay. So the rule is that if we have a change in accounting entity and the comparative statements are presented, change in accounting entity occurs in the current year, all previous financial statements that are presented in comparative financial statements along with the current year should be restated to reflect the information of the new reporting entity. In other words, now you got to consolidate both years. Never heard from that person again, because I have a feeling that they don't want to talk to me, because what? You get scary answers, okay? But that's the way you need to present it. Okay, question.
So when we're saying that we're consolidating these statements, does that mean that like there were two companies that are now one company?
There were two companies that were under the same ownership, and for whatever reason, they hadn't consolidated in year one in this example, but by year two, they decided they wanted to consolidate the two companies, and you want to prepare comparative statements, you need to consolidate both years' set of financial statements.
Okay, thank you.
Mhm. And since you hadn't done that last year, you'd have to do it, you know, this year and show them restated, but they don't call it restatement, they call it retrospective. So again, you see a, well, I'm going to do that after we talk about the next one here. So let me do this next one, then we'll talk about what I'm thinking you might see in the question. Okay, error correction. Error correction, guys, equals restatement. Now you use the word restatement. You use the word restatement now, okay? So what happens? If you were to see a question, change in accounting estimate, what's your approach? Your approach is prospective, no restatement, No, if they ask you about retrospective, it is simply prospective, right? Okay. If it is change in accounting principle, it's what? It is going to be prospective, no. Retrospective, yes. Restatement, no. Even though the thing that you do is you restate the prior period, don't use that word. If it is change in accounting principle, prospective, no. Retrospective, yes. Restatement, no, because you don't use that word for change in accounting principle, change in accounting entity. If we are talking about error correction, okay, prospective, no. Retrospective, no. We do what? We call it restatement. Even though we're going to see as we go through and what we're supposed to do with error correction, it's the same thing that we have said for change in accounting principle and change in accounting entity. Okay, so let's just take a look. Error corrections are not accounting changes, they are error correction. Okay, and if coming over the next page, if comparative financial statements are being presented, correct the information if is presented, restate it, which is what we do under change in accounting principle. For example, we use the new principle, but we don't call it a correction, we don't call it a restatement. Okay, so if comparative statements are presented, then we will, for the year with the error are presented, then merely correct the error in those prior period statements, restate them correctly, right? Adjust beginning retained earnings of the earliest year presented if the year affected by the principal, affected by the error, I should say, is not presented. So you made the mistake in, say, 2018, and you're preparing 2020, 2019 comparative statements, then you're going to make an adjustment for whatever the effect of that error is to the beginning balance of the 2019 retained earnings in that example, which is the same thing we said that you do a minute ago for change in accounting principle, but you don't call it restatement. Okay, and if comparative statements are not presented, then go ahead and adjust the beginning balance of the retained earnings for the only period presented, which is the same thing we saw when we just showed the 2020, and you made the error, say, in another year prior to 2020. Obviously, you would just make an adjustment to the beginning balance of the retained earnings, and you do this of the only period presented in that case, and you do these what? You do these net of tax. Okay. Okay, so go ahead and you can flashcard the rules here for error correction, but just kind of keep in the back of your mind that they're really pretty much the rules we followed for the cumulative effect and change in accounting principle, but we don't call it restatement. Restatement is a dirty word that is reserved for an error correction. The reason they're so careful, not to use the word, restatement there is, users of financial statements don't like that word restatement. They get spooked by that, right? So we don't want the company to have to call out that they had to do restatement. Restatement is say for something that went wrong. Okay. Okay, good. Now, you don't need that example, but come over here. And what I do want you to, oh, they don't show it. Oh, okay. Well, never mind then. There was something I wanted to show you, but I guess they took it out, so we don't have to worry about it anymore. Okay, good. So let's go ahead and let's take a look at our couple of questions here tonight. There's no question. Are there any questions on any of that?
One quick question. Going back, street change in accounting entity. let's say like company being, yeah, about the number 3. Let's
Mhm.
say company have filing as a consolidation financial statement, and like this year, if companies like sold out one of the business entity as a let's say company A, in that case also this change in accounting entity rule apply.
Um, no, I don't think so. I think it's more that, because otherwise you'd really be spending your whole life as,
Mhm.
time changes and you go around and now you had this company under your control and then you didn't, or you didn't have it, and now you do. And that could get a little messy.
Mhm.
I think what they're saying is it's two companies that were both in both years under the same control, same management control, but for whatever reason in year 1 you didn't present consolidated, and in year 2 you decide you're going to. That's
Mhm.
when this rule kicks in. Because otherwise, think about it, companies can acquire and spin off other companies back and forth over a
Yeah.
series of years, and that would get unruly, I think.
Yeah, so this rule is more for companies' decision making, whether they report as a non-consolidated or consolidation, but somehow company decided to go other way, then in that case they need to restatement.
Correct. And we're really
Okay.
probably talking about, a non-public entity that hasn't
Mhm.
gone public, because under a public company, you'd have to prepare the consolidation. But if we're going out and we're preparing financial statements, and in 1 year it was sufficient to have the non-consolidated, but by year 2, a bank or somebody says to me, hey, I want a consolidation, then the gap rule here would be what? Well, now you have to consolidate both years.
Yeah, it's clear. No, thank you.
Yeah. I don't know that the exam gets that sophisticated. They kind of ask it more in just sort of a general sense, but getting to your question, that's how I'm understanding it.
Yes, thank you.
Yeah. Guys, let me put a disclaimer. Please don't walk into your boss's office and say, my teacher said yesterday. Okay, if there's something that's going on and you have a doubt, I would open up a discussion, because I don't know necessarily what the nuances are of a particular situation. Okay, good. Let's go ahead and let's take a look at, and by the way, if you find out something different, I'm all ears on that if you want to talk to me about it, but please don't go in and say, I had the experience, one student that I taught them something and she was right. She stuck to her guns on it. And then when they had a layoff, she was the first one to go. Okay, so be careful. She was right, but what good does it do you if you don't have the job anymore? Anyway, so just be careful with some of that. Okay, so what do I want to launch my poll? Guys, be careful. Don't just read the first thing that sounds right and pick it. Okay, guys, I've given you about a little more than 2 minutes here, and it looks like just about everyone's had a chance. Maybe one person hasn't answered that yet. Maybe that's me. Okay, so let's just know one person hasn't answered, but let's just go ahead and let's take a look at this. I'm going to end the poll. This is a question that probably would have taken you, a minute and a half or so to work on the exam. And 67% of us got it correct because the answer is D. Okay, but let's just go ahead and let's take a look at this. Okay, and they tell us that we have accounting change the result in financial statements that are in effect the statement of a different reporting entity. We have change in accounting entity. Now, somebody picked A, and I'd like to hear why, because tell me anywhere where we said the cumulative effect adjustment is reported on the income statement. Did we say that anywhere? That the cumulative effect adjustment is reported on the income statement? It's reported where? On the statement of retained earnings. It's an adjustment to the beginning balance of the retained earnings of the earliest period presented. So A was way off. Now, B, a few folks chose it, and I think you got pulled in by this thing that is saying no restatements, and you stopped reading there probably, or got hypnotized by that, or adjustments are required. Now, hang on a minute. We know we're going to have to make what? An adjustment to the beginning balance of retained earnings of the earliest period presented to show what it would have looked like had we consolidated the companies previously. So there is an adjustment, and we are going to restate the periods presented, but we don't call it what? We're not supposed to call it a restatement. We call it what? Retrospective application, even though the reality is we end up restating those statements, but that's not the official title for what we're doing. We're calling it retrospective. So B is wrong because we will restate any prior periods presented. We just don't call it a restatement. So you can't say no restatements or adjustments are required. Yes, they are. It doesn't say what do you call it. Okay, we don't call it restatement. We call it what? Retrospective. So C is wrong, and I don't know where you would have gotten reason to want to do this, because if we're using the cost or equity method, there is no consolidation. And in fact, they don't even call it the cost method anymore. They call it fair value through net income method. So C was almost as bad as A. D, therefore, becomes the best answer. Financial statements of all prior periods are presented should be restated. That's why my student was crying probably, because now they had to restate those prior periods. Okay, so as though they had been consolidated, but you don't call it restatement, you call it retrospective. This is an important question to learn from. The CPA exam does this to you. They, it's like being in the ring with a fighter that, keeps giving you body shots. They're not going for the knockout. They're just trying to wear you down, right? Keep hitting you, keep hitting you, keep hitting you, and finally you drop your guard because you're just in pain, and then comes the knockout shot, right? So that's what they did with A, B, and C. They had you so worn down by the time you got to D, you'd lost your mind already. Okay, so you got to work on staying focused as you go through all the choices. Okay, sometimes maybe it makes sense to start at the last choice and work your way up while you're practicing. I don't recommend that on the exam, but while you're practicing, get used to maybe doing that, reading up the answer so you fall out of the habit of being influenced by choices just because they come sooner than later. Okay, let's look at number 2 then. No question on that one? Let's look at question 2. Okay, guys, we're coming up on 2 minutes here, and I'm not sure what's going on, why it would take you much longer than that. So I'm going to go ahead and end the poll. And okay, we had some people, 3 of us, choose D. So one of the people that chose D explained to me how a change in estimate is an error. How is a change in estimate an error for the folks that chose D? They estimated it $100, and then experience indicated that the estimate should have been 110. How is that an error?
So are we assuming, sorry, are we assuming that the statements were already done then? I guess I was kind of confused on that because
Is changing an estimate an error?
no, but I mean, if you use an estimate to create your financial statements, then doesn't that sort of make it record? I mean, that's kind of where I'm confused, I guess.
Use an estimate. You prepare your financial statements using that estimate. Now, that doesn't mean you can be sloppy about the estimate. You're careful about the estimate, but then it turns out that the estimate didn't turn out to be true.
Correct.
So you're going to go back and change the financial statements for the previous years? Because if you think you're going to do that, the bad news is you'll be changing your financial statements every single year.
Yeah, that was kind of the part I had it was between that and I think I was looking at B also, but then I didn't really see it as an accounting change per se. So I'm a little hung up on the terms and I don't know. I just
Well,
wasn't sure.
it's not an error to have a difference in estimate, like the trucks. We thought it was going to be a 10-year life, turned out to be a 5-year life, whatever it was, right? Here, we thought it was going to be $100 per unit, turned out to be $110 per unit.
Mhm.
So what do? When you get that better estimate, you say, okay, well, that was then, this is now, and I'm going to use the new estimate going forward, right?
Mhm.
Prospective
Okay.
application. So that means I'll use that new estimate in what? In year 2, now that I have that better estimate, just like in the example that we looked at with the truck in year 3, when they had the better estimate, they used that in year 3, right?
Yeah, I guess I just got confused on that one too, because it says as income. And then we're talking about costs, right? So I guess like I thought of that as more of an expense. So I don't know. Maybe I just don't know my accounting well enough to back
The
that one out.
effect of the difference of this $10 difference from the estimate is reported in year 2 as part of income from continuing operations.
Yeah, isn't that a cost? So it would be a warranty expense, or did I read that
Well,
wrong?
a cost can be an unexpired cost or an expired cost, right?
Right, that's true.
If
Yeah,
it's an unexpired cost, then it's an asset. If it's expired cost, then it's an expense, right?
gotcha. Okay, that's where I got hung up. Okay, sounds
Okay.
good. Thanks.
Okay, but thank you. No, but thank you. That's all good discussion. I'd much rather have that kind of a discussion than silence, okay? So thank you. Who was that?
Was
Who was-
Melissa?
Okay, thank you, Melissa, for that.
Sure, no problem.
Okay, okay, item B, some folks chose, let's see, we had 2 people choose B. An accounting change net of tax below year 2 income from continuing operations. Anyone want to talk about what the heck that was supposed to mean? I don't know what to tell you. I mean, it's one of those, you know, as my dad was getting older, he would say things that I'd be like, and then I would just sit there stunned because I didn't know how to respond to what he just said because it didn't make any sense to me. Okay. So no, I mean, I don't know what to tell you. That just sounds like a drunk accountant. Okay, and then C, an accounting change and the year one statement should be restated. No, retrospective application, we do not restate. I mean, excuse me, prospective application, we do not restate. Okay, all right, guys, so you're gonna have to build up some scar tissue with these a little bit. I mean, half of us got it right, and it was the most popular of the choices, but still we had some stuff kind of flying all over the place on this one. Okay, okay, so again, I am your teacher, but I'm also your coach. So I'm coaching you up into, you make the mistake here, that's fine. As you go through your homework, you should start to eliminate that mistake. And then obviously by the time you're on the exam, you are minimizing the mistake to where you're not, you know, you're not going to make it anymore. Whatever that, you know what I mean, you know what I mean. Okay, all right. Now, when we look, and the reason I decided to kind of go to the back end of the chapter first, and then we'll come back to revenue recognition later, is that we're still sort of talking about the income statement. Okay, now when we look at our calculations of income, really, okay, but let's just review the income statement for a minute. Talked about this last time. We talked about the multiple step income statement. Remember that? Okay. And we had what? We had our sales. And then we subtracted what? Cost of goods sold. And that gave us what? Gross profit, whatever. Gross margin, you see that sometimes, okay? And then what? And then we came and we started dealing with operating expenses. Right? We reported some of those operating expenses, whatever. And after we subtracted our operating expenses, our sale and administrative expenses, that sort of thing, general selling and administrative expenses, what was this line? Gross profit minus operating expenses, what goes here?
Income from operating.
What?
Income from continuing operations,
No.
from operating. From operations.
Operating income, okay.
I've seen both, maybe I'm mistaken, but I thought I saw both operating income and income from operations. Those are the same thing, right?
Yeah, that's
Okay.
fine. Yeah. Okay, good. And so all of this was what? Operating items?
Yes.
Okay. And then we had what? We had a section for non-operating items. And these were things like what? Interest, gains and losses, like from the sale of equipment and stuff, tended to be non-operating items. Okay. So after we dealt with those non-operatings, and they could be both revenue and expenses, guys. Okay. But after we dealt with those, we ended up with what? Somebody said it earlier.
Income from continued operations.
Good. Income from continuing ops.
Oh, we need the income tax though. So maybe.
Oh,
income
thank
before
you.
tax.
Thank you, thank you, thank you, thank you, thank you. So then I would have to have what? Tax. Whatever my tax is. Thank you. You can see I'm not a tax guy because I tend to forget about tax all the time. And then I'd have what? Somebody said it.
Income from continuous operation, net.
I don't know what net means, but
Like after tax.
income from continuing operations. Then what would I have? Potential.
Discontinued operations.
Potentially good. I could have discontinued operations. Come on, pen.
Can I
Yes,
ask
Kim.
you a question? In the questions that we have for the homework, they were adding the depreciation in the G&A cost. And
Okay.
I got confused because in the material it says depreciation should be outside. But
I don't know.
in the question,
FASB doesn't get up in our face to the level of individual line items that we're showing in these sections. They say operating versus non-operating tax, and there's a certain amount of latitude in terms of how you report those operating expenses. So you could show depreciation explicitly. If you look at, say, Apple's financial statements, Apple shows general and administrative expenses, and then they show research and development, because those are the two main, and they kind of roll everything into general and administrative, and then they make the choice to call out research and development, because for a tech company, you know, that is sort of a big expense. So there's a certain amount of flexibility in there. So I'd have to understand exactly what question we're looking at to see if there's a CPA exam solution question in there, huh?
Yeah, I was thinking for the exam itself, maybe we should, you know,
I
I saw the question.
It depends on the question. You know, what I'm telling you is how it works, that FASB doesn't get up in your face and say, well, you got to report a line item for research and development. Well, I know it's an expense, but they don't tell me that I have to call it out as a line item, but a lot of companies do. You know, depreciation. Okay, you could maybe roll it into general administrative, or you could call it out as a separate line item on the presentation of the income statement.
But for the exam, I think the majority of the questions in Becker were more included in G&A. So I was wondering if that's what the exam is going to be like.
I have to see the question. The exam, now you're asking me to answer a question about a question that I haven't seen. I mean, I may have seen it, but I don't know what question you're talking about. So if there's some nuance in a question that you want to address, I'm happy to do that. But in terms of what the rule is, it can be done different ways as to how it's presented. And then how the question is kind of trying to move the shells around in that, I'd have to see the question.
Yeah, that's okay. That's
Yeah.
Thank you.
Okay. Okay. Then you have discontinued operations, and you have the loss from the operation, impairment, disposal gain or loss. You don't have to show all those. You could show it as one amount. And so after you deal with the discontinued operations, I'm going to put some big X's there, since I'm pretending we're showing it as one amount, just reminding you all the things that go into it. Then finally, and that's all what? Net of tax too. Right. Then you have what? Net income.
Net income.
Good. Okay. So when you look at that, that's what they're saying here without as much detail. Okay. Income from continuing operations, which includes operating and non-operating items, and tax, and then you have the discontinued operations. Now, what happens? You look, and some years back, users of the financial statement complained to FASB and said, you know, we're really not happy that you take certain things and you dump them straight into stockholders' equity. Okay, I'll tell you what. Just remember the income statement and we'll talk about other comprehensive income after we come back with the break, since the software is effing with me now. Okay, so we're gonna take a break. We'll take a break till 6:30. Okay, and then we will come back and start talking about comprehensive income. But what we just talked about was what? The net income part of comprehensive income. All right. All right, guys, I'm gonna have to, because I'm gonna have to close the software. So we'll come back. I'm gonna pause the recording and we'll come back in about 10 minutes, okay? Resume the recording. And as we went to the break, we were talking about the notion of comprehensive income, okay? Now, we reviewed, although I had to discard the example we had of how we would put together the income statement part of net income. And then some years back, users looked and they said, look, you have things that don't hit the income statement that ultimately end up affecting the company's stockholders' equity. Can you do us a favor and show us how those things would have affected net income if they had been reported on the income statement? So FASB came up with this notion of comprehensive income, and they took things that were affecting stockholders' equity directly and included them in a concept of other comprehensive income. And we're going to look at the presentation methods in a minute, but it shows what this concept does is allowed us to say, well, this is net income, and here's how these other things that were previously going straight to stockholders' equity would have affected net income had you reported them, say, on the income statement. Okay, so that's called comprehensive income. Comprehensive income is my net income, like we just calculated, like I just reviewed with you, plus other comprehensive income. Okay, now other comprehensive income, and there's a finite list of things that constitute other comprehensive income. Okay, and they have a mnemonic for this. Okay, and the mnemonic for the other comprehensive income items are pension adjustment, P, U, unrealized holding gains and losses on available for sale securities, F, foreign currency items, and E, I should say I, instrument specific credit risk. Okay, and we deal with these things in some of the other classes. The main one that we're going to deal with in F4 up here is probably the more heavily tested one, and I'm going to give you some examples tonight, even though we won't get to that till F4. These other areas are in and of themselves are fairly small tested items, but you should know the elements of other comprehensive income. So flashcard and use the mnemonic PUFI, Puffy, I guess that stands for. Okay, and make a flashcard at a high level, just the things that constitute other comprehensive income. Okay, so we have what? We have comprehensive income. Comprehensive income is net income plus other comprehensive income gives us comprehensive income. Now, they say here that comprehensive income is the change in our equity during a period from transactions other than events and circumstances from non-owner sources. It includes any and all changes in equity during a period except those resulting from investments by owners and distributions by owners. So when owners make investments in a company, what does the company issue them? When you make an investment in a company, what do they give you? Stock, okay, good. So comprehensive income does not include stock issuances or what? What's a distribution to an owner? What do you call that?
Earnings.
Huh?
Earnings,
Dividends.
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 Okay, so flashcard that. Comprehensive income does not include changes in stockholders' equity that are coming from what? Issuances of stock or what? Or dividends being paid. Stockholders' equity changes as a result of those things, but they are not part of comprehensive income. Net income and other comprehensive income items are part of comprehensive income, obviously. Okay, other comprehensive net income, as we've seen, is what? Is income from continuing operations and discontinued operations. Income from continuing operations is operating, non-operating, and tax. Discontinued operations, the lid mnemonic, that's all net of tax. And then you have other comprehensive income items. Okay, now what I want to do is jump ahead, okay, because while we have this concept of structuring of the income statement and stuff, I just want you to see the methods that are available for presenting my comprehensive income, okay? And you can either have a single statement approach or you can have a two-statement approach. Under the single statement approach, what do? We, and again, overkill here the way they did put this all together, but we basically have the, they call it statement of comprehensive income. We have what? Our revenues, our expenses, income before tax, okay? There's our tax, there's our net income. And then we just keep going with those other comprehensive income items. So we basically just stick the other comprehensive income items, what? Okay, to hell with you then, I won't circle it. We have the other comprehensive income items, what? Just stuck down there to the bottom of the income statement. And then we have comprehensive income. Now, most companies don't like to mess up their income statements. So most companies, okay, probably take the two-statement approach, in which you'll just see the income statement looking like this, right? And then they'll have a separate report in their financial reports, a new piece of paper that basically does what? Starts with net income and then goes ahead and puts in the other comprehensive income items. And that's what most companies do. They have basically a statement that just shows net income and then another statement that says, okay, here's what our net income was on the income statement. And now here's the other comprehensive income items. Okay, so those are the two approaches, guys. I don't know if you need to flashcard that or not. You can if you want. I guess that's an optional flashcard. But you see that FASB was satisfying the desire of the users of financial statements by saying, hey, here's net income. And here's how these other things would have affected net income had they been reported, say, on the income statement, or hey, start with net income and show how they affect it. Okay, now you come over and you start to take a look at a couple of things. Okay, and so I'm coming back up and let's look at accumulated other comprehensive income. Okay, and I want you to put down that AOCI, okay, AOCI is like retained earnings for other comprehensive income items. What are our other comprehensive income items?
Foreign
Which
currency
item?
effects.
Huh?
Foreign currency effects.
Well, there's several of them, right? There's other comprehensive income items include the pension, the unrealized, the foreign currency, and the instruments. Yes. So yes, you were partially correct. It's those items that we just talked about, right? Okay, so it's like the retained earnings. So what happens? Year to year, we report other comprehensive income items and see how they would have affected net income. But then, like you do with all income type items, you close those out back to zero at the end of the year, don't you? revenue goes back to zero, expenses go back to zero, all your other comprehensive income items go back to zero at the end of the year. And you close what? Income items to retain earnings. You close other comprehensive income items to accumulated other comprehensive income, and you show that down in your equity. Okay, so notice that they tell us here that what? Accumulated other comprehensive income is a component of equity that includes the total of other comprehensive income for the current period and all previous periods, just like retained earnings has what? The income for the current period and all other previous periods built up in it. Okay. Okay, and that's where they say it's similar to retained earnings, right? So go ahead and flashcard that, but let's just go ahead and, as I showed you at the beginning of class tonight on e-learning, I have this example right here. Okay, and this is showing how accumulated other comprehensive income and how we'll report other comprehensive income for just one of the items. I think that one of the mistakes that Becker makes in this section is they start trying to give you these, complicated examples of these, effective, instrument-specific credit risk examples and stuff. Meanwhile, we're not ready to wrap our heads around something that complicated. So I'm going to go ahead and go with something a little simpler here. I feel that the unrealized holding gains and losses is probably the easier one to talk about, okay? Even though we'll get more into it in F3. So in this example, I say that a company purchases available for sale marketable security 1 in year 1. Now, when they buy the security, of course, they will do what? They will debit the cash for whatever they pay for that. I'm assuming 500,000. I mean, debit the cash, debit the security. Hello, John, basic accounting, please. And credit the cash when they buy that security. Okay. Now, what we are required to do with an available for sale security is we are to look at it and see if there's been an unrealized holding gain or loss, assuming we haven't sold the thing, by the end of the year. And in this example, I say, well, it's worth 600,000. So it's gone up in value, what? 100,000. So you go ahead and you debit available for sale security 100,000. Now it's on the balance sheet at 600,000, and you credit unrealized other comprehensive income gain for 100,000. Okay. Now, at that point, you are ready to prepare your comprehensive income statement, and I'm sort of taking the one statement approach. Okay, and guys, where is it? For year 1 right here. Okay, this is year 1 right here. I'm just assuming, I'm just pulling it out of the sky, that my net income was 50,000. My what? My other comprehensive income, which was basically made up of that one thing, the available for sale security, is 100,000. So my comprehensive income is what? 100,000. Question so far? Okay, now, just like all income statement items, okay, I have to close my regular income items. I close my revenue, I close my expenses. I have to close my other comprehensive income items. My income, I close to what? My net income, I close to retained earnings. My other comprehensive income, I close to accumulated OCI. So basically, to close my OCI, since I had just what? I had just credited it there. See the one? I had just credited it there, okay, when I recognize that gain. Now to close, I do what? I debit it. It's now showing it 0, which all of your other comprehensive income items get closed back to 0. And I would do what? I would credit my accumulated OCI for 100,000. So now my accumulated OCI has what? On the balance sheet, I have my stockholders' equity. I have my retained earnings, assuming this was the first year, let's say, of operations for this company. My retained earnings is 50,000. My AOCI, my accumulated other comprehensive income, is showing at 100,000. Questions so far? Okay, good. Then I go into year 2. Okay, and this is year, I probably shouldn't put that blue there. That really belongs to the year 1 example. Okay, you can see it right there. And then I go into year 2. And in year 2, they purchase a second security, a whole nother security. They pay $1 million for it. So they go ahead and they debit available for sale security number 2 for $1 million, and they paid cash for it, so they credit the cash. Okay. At the end of year 2, they sell the security that they had bought in year 1, available for sale security 1 for $600,000, and the second security that they bought in year 2 is now gone up to 1.4. Okay. So first, let's deal with the sale of the year 1 available for sale security 1. They sell it for $600,000. They obviously debit cash for $600,000. They credit the security for $600,000 because they sold it. So now for that security 1, it's gone. They sold it. They debit the cash. But now they have to do a reclassification adjustment. Okay. And with this reclassification adjustment, what they're going to do is they're going to debit unrealized OCI, okay, and they'll debit that for 100,000, and they'll credit the realized gain, okay. So there's the debit for that security that they post there, and the realized gain, of course, is going to go what? Is going to go on the income statement. It's going to be probably non-operating item, but it's going to be part of my income from continuing operations showing up on the income statement, right? And then they have to what? Account for this gain of 400,000 for the security they bought this year. They paid $1 million. It's now up 400,000. So they debit available for sale security 2 for 400,000. They credit the unrealized gain for 400,000. That's an other comprehensive income item, unrealized holding gain or loss on available for sale security. And so they go ahead and that gets recorded as OCI. So now when they go to prepare their statement of comprehensive income, I'm showing what? Net income of 100,000. I'm assuming there were no other income items. All we had was the gain from the sale of that available for sale security. So by the way, guys, my comprehensive income up here should have been what? Not 100,000, but 150,000. Comprehensive income is net income plus other comprehensive income. Okay, so then I look, and when I prepare my financial statements, I look to see what's in my ledger, and I have a balance here of what? 300,000, don't I? Okay, before I close it, I have this balance of 300,000 sitting here. Okay, and so I go and I report 300,000 other comprehensive income, and so my comprehensive income is what? 400,000. Now, at this point, my users of my financial statements have what? They're not really seeing the whole story here. I mean, they're seeing my net income of the realized gain. They're showing an OCI 300,000, but they don't know that part of that 300,000 included what? A reclassification adjustment in which I sold a security that went from comprehensive income, other comprehensive income to net income. And I really had a 400,000 gain on securities I held for the period. And we're going to do some disclosures to get around that here in a second. But what I want to show you here now is what? Now I have to close my what? My other comprehensive income. So since there's a $300,000 balance here, I do what? I debit OCI, I credit my retained earnings, my accumulated OCI. There was the 100,000 in there from the previous year, and now there's what? This 300,000 in there for the current year. And guess what? It should have 400,000 of my cumulative OCI because the security, the balance sheet's got a balance, and I marked up that security to 400,000, didn't I? So the balance sheet balances through this process. Question. Now, as I stated here, note that the statement of comprehensive income, right here, would show 300,000 unrealized holding gain, right? That's that OCI 300, which is the net of the increase for the held security and a decrease caused by the reclassification adjustment for the sold security. As a result, the company would have to disclose information discussed at the bottom of page 64 in your text. Okay, so let's first go back to the text. Where am I going? Any question on this example right now? Okay, so let's go back to the text. Okay, and let's first look at what they tell us about reclassification adjustment. Okay, and reclassification adjustments move other comprehensive income items from accumulated other comprehensive income to the income statement. Isn't that what we saw? The reclassification adjustment, that 100,000. Okay, now you come over, and now I want to look. We saw the different reporting methods for that, so we don't have to worry about that anymore, right? We saw the different one statement versus two statement approach, so we don't have to worry about that anymore. But I want you to come over to, let's see, let's come over to page 64. Okay, as I said, you'd see them at the bottom of page 64. Okay, now this is where I'm not happy with the way Becker started getting into some of the items that they're talking about here, because it's too much for us at this point. So let's just mark this thing up a little bit. What happened? We had amount accumulated other comprehensive income components. And in our little example, forget these other things, okay? They shouldn't be doing this. This is too much, okay? So forget these, forget this, okay? Let's just have our sale of AFS security. That's the only thing we had, right? And the amount reclassified from accumulated other comprehensive income, right? In our example was just this, maybe I should have wrote it up here, whatever, the 100,000. And so the total was 100,000. Okay. And then we would see that that was what? That was, and the line item that was affected was gain on sale of available for sale security. And that's going to just show on my income statement, right? Okay, so they say where income is presented, it was the line item gain on sale. And I ignored income tax on that. If you had, you know, the tax information, you would show the total before tax, and then the tax expense or benefit, there'd be a tax expense since that was a gain in our example. So if our tax rate was 40% or something, we'd show $40,000 of tax, and net of tax would be 60,000 for that. I'm not going to write all that in. But now you can see, okay, we had what? We had something that came out of other comprehensive income and went into what? Went into net income. And you can see that right here in this disclosure. Okay. Then the other thing that you would be showing over here is you would be showing what? you would be showing, well, for my other comprehensive income, and it's just the one, it's just the available for sale security in our example, so you wouldn't have all this, okay? But you would show that what? My accumulated other comprehensive income, right? Just for the available for sale, it's just the one thing for the available for sale security, had a total of what? 100,000 at the beginning of the year, right? That was that from the first security that went from 500,000 to 600,000 year one, start of year two. Okay, in our example would be the start of year two. It had what? 100,000. Then we had what? Then we had other comprehensive income item before reclassification. That was the 400,000 that was from that security too. It went, we bought it for $1 million, it went up to 1.4. And then we had what? The reclassification, which was that 100,000. That was the reclassification. And so the net current period other comprehensive income that you see on the comprehensive income statement was what? 300,000. And so if you started with 100, you went up 400, but you reclassed out 100, then you added 300, then the ending balance is what? 400,000, which it is. That's what we saw on that example that I gave you, was 400,000. So these disclosures that you see here now let the user see, oh, okay, I got it. You start out with 100,000, you sold something. So it looks like you sold that thing that you had taken an unrealized gain for before, but it looks like during this year, you had gains of 400. That's why I'm seeing a net of 3. And that's how I got to the ending balance of 4. Question. So when we look at the required disclosures, okay, coming back up, and let's start at the bottom here, okay? And the total accumulated other comprehensive income is on the balance sheet as an item of equity. You pick up the balance sheet, you'll see retained earnings, you'll see what? Accumulated other comprehensive income. In this example, it's going to be the 400,000, okay? Now, the reclassification adjustments, which are made to avoid double counting in other comprehensive income items that are displayed in net income for the current year. That's FASB's fancy way of saying what? Previous reported unrealized gains that were realized during the year. That's the 100,000, but that's FASB speak, that double counting, because FASB is a bunch of nerds. And so they say words like that. So don't get confused if you see that phrase double counting. All they're talking about is I had something that was unrealized. It was part of my other comprehensive income in the previous year. It's resting in accumulated other comprehensive income. Now I sold it. So I'm going to show the gain on the income statement, and I'm going to take it out of accumulated other comprehensive income. Okay. So for those things, we have the disclosures, and these disclosures are the things that we just looked at on the previous page. And I want you to go ahead and flashcard these. And they are changes in the accumulated other comprehensive income by component of other comprehensive income. The entity must separately disclose reclassification adjustment and current period items. And we did that, and we only had the one, so we didn't have to list all of them. But if you had other ones, pension, whatnot, you'd have to show that. And then significant items that were reclassed out of accumulated other comprehensive income must be disclosed on the face of the statement, okay, where net income is presented, or a separate disclosure in the notes. And again, that's what we see on that next page. Okay, so go ahead and flashcard those disclosures. We saw those on that next page. And then, really, you know what, I want you to flashcard this right here. I don't know why I had to destroy everything else. I want you to flashcard these two things. Okay, and then regardless of what format you use, the 2-statement approach or the 1-statement approach, and I want you to flashcard this, you have to disclose the tax effects by component. If you have more than one category, you have pensions, you have available for sale, you have to disclose the tax effect. The changes in the balance. Well, look, guys, the changes in the balance are what you report on the comprehensive income statement. And you can show the total amount for all of your OCI items as one amount, or you could call it out by item. But if you show it as one amount on the face of the comprehensive income statement, then you're going to have to disclose the components if you have unrealized gains and losses, if you have pension, etc. Okay, and then changes in the accumulated balance by component, they tell us, can be shown on the face, which was what the example showed us, or in the notes. Okay, but somewhere you're going to have to show the components. So again, on the face of the other comprehensive income statement, comprehensive income statement, you could show it as one amount, or you could show it broken out the way they showed you of the different amounts. But somewhere, then if you show it as one amount, you'll have to disclose in the footnotes what were the components. Okay, question. Good. So with all that, let's look at a question. Oh, the poll, right? Okay, guys, I'm going to go ahead and end the poll because it looks like just about everybody that's been participating tonight was able to try this one. Okay, here comes a late answer. Ruined the perfect. And that late answer ruined the perfect and also insulted me because it's asking comprehensive income includes changes in equity resulting from which of the following, or I should say it excludes. And we just went through an example of unrealized losses on non-current marketable equity securities. So although I don't really care for that answer. I don't know why they're saying equity securities. Debt securities probably would have been a better answer. Okay, anyway, this question got some problems here. Okay, but unrealized losses on certain investments like a bond or something would be part of what? Would be part of my of my comprehensive income. Okay, it doesn't exclude it. We just went through the example. Okay, now loss from discontinued operations. No, we saw that what in calculating net income, loss from discontinued operations is part of that. prior period error correction, well, just think back to the example of the change, a prior period error correction where we forgot to record some amount as revenue or something. Well, that would affect my what? My net income, and therefore would affect my comprehensive income. Dividends paid to shareholders, yeah, that's why I asked you to flashcard that. Investments by owners or distribution to owners are not part of my comprehensive income, and a dividend is a distribution to owners. So no stock issuances, no dividends, no treasury transactions. They are not part of comprehensive income. Okay. Question? Okay, good. Let's come over then and let's start to look at adjusting journal entries. Okay. Now, adjusting journal entries, guys, are what you do when you have some kind of error or you have some sort of accrual that's coming to the end of the year that you have to make. Now, this really is almost an introductory to accounting type discussion, okay? But the CPA exam sort of ramps that up to a steroid level for it, and you really got to be careful as you think through how to fix an error or adjust something at year end that needs to be adjusted, okay? So you come over and they talk about adjusting entries, and guys, I'm not going to belabor the adjusting entries. You know that when you receive some cash and you haven't earned it yet, you debit cash, you credit unearned revenue, okay? And then at the end of the year, if you've actually earned that revenue, you would debit the unearned and you would credit the revenue, okay? And I'm not going to go through every single one of these. I'm assuming that if you got this far, you understand that, okay? Let's look at error correction, okay? And let's go ahead and flashcard the rules for error correction, what we call adjusting journal entries, okay, for errors. And adjusting journal entries must be recorded by the end of the entity's fiscal year before we issue the financial statements. Adjusting journal entries never involve cash amounts, and all adjusting entries will hit one income statement and one balance sheet account. So those are good things to keep in mind. So flashcard those going into the exam so you kind of remember those rules of thumb. Okay. Now, again, I don't want to get into a lot of detail of these adjusting entries. I think that you know a lot of that, but let's go ahead and let's look at this sort of maybe even a task-based simulation in which they might give you a listing of errors that the company made, and they want to say, hey, you CPA, can you fix this? Can you cure a set of financial statements that are ill, that have some errors in them, right? Okay. So let's look at the description, and they tell us the company purchased a 3-year insurance policy on January 1st, year 2, and expensed it all. Okay. Now, is that what you're supposed to do? Are you supposed to just sit there and debit expense and credit cash for a 3-year policy?
No, supposed to accrue it as it is used.
Well, you would first set it up as an asset, right? I mean, sometimes it helps to think of what the correct entry would have been, which would have been to debit what?
Prepayment.
Prepaid insurance. Let me do it with T accounts. I think it's a little better to do it that way for 300. And of course, you would have credited cash. I'll put cash over here, because cash is not really something you need to worry about for the adjusting. Right? Okay. Now, if it's but not 100, but 300. Now, if it's a 3-year policy, right? You take that 300 and you divide it by 3, obviously, and that's $100 per year. And so what you should do is what? You should, at the end of the year, credit the prepaid for 100 and debit what? Debit the insurance expense for 100, right? You should have a balance anyway at the end of the year of 100. Now, what they did is they went ahead and when they credited the cash, they debited the whole expense, didn't they? So right now, insurance expense is showing a balance of how much? Of 200. You want it to show a balance of what? Of 100. So what do? You credit insurance expense for 200 and you do what? And you sit there and the well, they didn't do this. It's showing what? The prepaid insurance is showing now what did I do to myself? The prepaid insurance is showing what? Showing nothing. And so it needs to show 200, doesn't it? Because that was what would be left at that point. Okay, so what do? You go ahead and the journal entry, which I showed you in T accounts, is to debit the prepaid for 200 and credit what? Insurance expense for 200. And when you do that, credit the insurance expense for 200. Now it shows 100, and now the prepaid shows 200, which is what should be, right? Question? Now you look at this second one, and they say a $2,000 credit sale made during year 2 was not recorded. Okay, and then they didn't record it until they collected it in cash in the next year. Okay, so what happens? Well, you should have gone ahead and at the end of the year, or when the sale was made anyway, but by the end of the year, you should have debited accounts receivable for 2,000 and credited what? The revenue for 2,000. Okay. Okay, good. And then when it gets collected in cash later on, I don't know, they don't tell me what year it is, but we'll assume it's that next year. Receivables really shouldn't be outstanding for a long time. Then you would go ahead and debit the cash, credit the account receivable. Okay. Okay, good. Cash totaling 3,000 was received in advance from a customer, was recorded as service revenue. Only 30% of the service revenue had been performed by year end. So what happens? If you're sitting there and it was 3,000 that they gave you, and you had only what? Earned a third of it. If you divide that by 3, you should have only earned what? 1,000. They took the entire amount as what? Revenue. Meanwhile, they had only earned 1,000 of that. What are they doing to me here? Or a third, not divided by 3, but a third. So they should have multiplied that by what? By 1/3. What the hell is going on here? So a third, not a third, but 30%. Let's see what I'm doing wrong. 30%. Okay, so times 0.3 means they've earned what? 900 of that. And so what they should do is debit what? Debit revenue for 2,100 and credit what? Credit unearned for 2,100. When they do that, now the revenue account correctly shows 900, and I'm showing that there's 2,100 of unearned. Number 4, the accountant discovered that a $450 utility bill covering the month of December had not been entered in the account payable system. If it's utility, then what? We're going to expense that. So we should have debited the expense for 450 and credited what? Account payable. That one's pretty easy, okay? $4,000 rent was prepaid on year one, covering a 4-year rental period. No entry was recorded in year two related to this prepayment. So what happens? They forgot to do the accrual, the 4,000 divided by what? The 4 years. So we should have debited rent expense for 1,000 and credited what?
Prepaid rent.
Prepaid, good. For 1,000, okay. Number 6, the direct write-off method, which you're not supposed to use, was used to write off 650 bad debt in year two, although the company uses the allowance approach. So you don't wait till the person tells you they can't pay. You're supposed to do what? You're supposed to take the bad debt expense and the allowance in the period of the sale. They waited till another period to when the person came and said that they couldn't pay. So what they should have done was what? Go ahead and debited the allowance for bad debt expense. It was correct to debit the allowance and credit what? Credit the bad debt expense for 650, because theoretically they had done what? They had debited the bad debt expense in the period of sale, credited the allowance. Now the person isn't going to be able to pay. So what do? I go ahead and I debit the allowance. I credit the bad debt expense. Okay. All right, good. Then what? Then the company purchased 1,300. 1 second, guys. Yeah.
I guess you have to assume no entry has been made,
Yeah, no, I'm
as
looking
opposed
at
to
numbers,
say half or something.
please. I'm debiting the allowance, I'm crediting the bad debt expense. Oh, I see. I'm sorry, Eric. The problem I was having with number 6 is what about the receivable? But the mistake that they made, the wrong journal entry that they made when they heard that the person wasn't going to be able to pay them, they debited bad debt expense for 650. This is the wrong thing to do. And they credited what? The accounts receivable for 650. That's what they did. Under the allowance method, the correct way to have done that at the time that you realized the person couldn't pay you was to debit the allowance for 650 and credit the receivable for 650. Well, the credit to the receivable was okay. That's what they were supposed to do. What they weren't supposed to do was debit the bad debt expense. So to correct it, we did what? I mean, the allowance. To correct it, what did we do? We debited the allowance, we credited the bad debt expense. That fixed the what? The wrong part of this entry, right? Okay. Does that make sense? Okay, good. Number 7, the company purchased 1,300 raw materials at year end. They were shipped free on board shipping point. And Eric, were you talking about this one now? Who was talking?
Yes, I was talking about this one.
Yeah, okay. And the goods were not included in the actual year end. Well, if it's free on board shipping point, it's ours as soon as it gets on the truck, right? So yeah, it's just a simple do what? Debit inventory for 1,300, credit accounts payable for 1,300. That one's easy, right? And then the company purchased and available for sale security during year 2 for 1,500. The fair value at year end total 2,000, but no adjustment was made. We do what? We debit the AFS 500. Since it's an available for sale security, we credit the OCI. Okay, all right. So I go through those with you there, guys, just to save you the flipping back and forth. I mean, you probably could have looked at that on your own, but they have also listed all the entries for your review again later, along with explanations. Okay. All right, let's look at this question. Oh, before you look at the question, the way I recommend you do these is say to yourself, what should be the right amounts that are in these accounts, okay, based on the fact pattern? What did they do? How can I fix it? Okay, or maybe what did they do? What should be, how can I fix it? That's the way to look at these problems, okay? And these aren't the easiest things in the world, but I think if you break them down like that, what did they do based on the fact pattern? What should be the account balances based on the fact pattern? How do I fix it? Okay, and that's really what this question is asking for. Okay, guys, that's 2 minutes, but I'm going to give you a little more time with this one. I could see this one taking you maybe 3 minutes on the exam. So no question should go over than 3 minutes. Some can be answered in 30 seconds, some 2 minutes to average out to 1.5 minutes per question. But I'm going to give you a little more time with this one. Okay, guys, we're at about 3 minutes, and so there comes the last choice that it always seems to pick D for some reason. Okay, but let's go ahead and let's take a look and let's see that we did pretty good on this one. Okay, 77%. The answer is B. Okay, and that's pretty good for a tough question. But let's just go ahead. And again, the steps that I'm recommending for this is what did they do? What should be showing correctly in the account balances? How do I fix it? Okay. And so that's what they're asking me for. They're asking me for the adjusting journal entry to fix what they did wrong. Okay. So what did they do? They tell us that they paid 90,000. Okay. And they paid 90,000 for services that they will receive evenly over a 6-month period from November 1st, year 1 through April 30th, year 2. So what they did was the company expensed the entire 90,000 cash payment. So that means that they did what? They credited cash for 90,000 and they debited an expense for 90,000. Meanwhile, that thing is going to continue to provide benefit into the next year, right? Okay. So what I would do at that point is I would say, well, they put expense of 90,000 and the expense really should benefit what? And it says that it is a 6-month deal. So 90,000 divided by 6 months means that really they should have taken what? 15,000 a month for the expense on this. Now they bought the thing what? November 1st. And so that means they should have taken expense for all of November, all of December, all of November, all of December for 2 months. So the expense should have been what? 30,000. Meanwhile, the expense is showing how much? 90. How do you fix that problem? You've got an account showing a debit balance of 90. You want it to show 30. What should you do?
Credit it for 60.
Good. Credit it for 60. And if you credit it for 60, you start to look and what? Credit service expense for 60,000. You're done with this question. Right? That's the only one that gives you credit to service expense for 60, which is what you need to do. But of course, your debits have to equal your credits, and the prepaid asset here had nothing because they put it all in expense, but it should show what? Should be 60. So to get the 60 balance, I'm just showing the balance down here on the debit side. To get the 60 balance, then what? They should have debited it for 60, which again is what they're telling us in choice B. Question. What did they do? What should be the correct balances in there? How do I fix it? Okay, question. And we're a little bit early, and I could push it and say that I'm going to go back to those 2 modules, but I think we're at a saturation point, both for myself and for you. So I'm going to end class there. We will pick up next time chapter 1, modules 3 and 4. That'll take us about an hour or so to go through. And then we'll get into chapter 2. Okay, so right now you're responsible for what? Modules 1, 2, not 3 and 4 because we haven't done them yet. 5, 6, 7, 8, right? Question. Question.
I have a question. So I didn't respond to the homework on how to look at the FASB codification. Maybe I need to go back to your recording, and I don't know if it was. I know you
All
explained it on the
recordings are up there.
Yeah.
The recordings are up
So-
there.
Okay. Okay. I just didn't know where to go and find it. I'll go to the recording.
You don't know where to go to find the recordings?
No, the FASB.